I'm Richard Vague with Tyco's reporting from on the road this week in Washington, D.C. You want to know what makes economies grow? It's pretty simple. It's debt growth, especially private debt growth. Whether a company wants to build a factory or an individual wants to build a house, the very kinds of things that register as increased economic growth, it most often involves debt. This chart shows you just how tight the correlation between private debt and GDP really is. The correlation here is 0.9794, a remarkable level. Notice how that correlation breaks down just a bit in 2020. That's, of course, when GDP collapsed with COVID and the private sector stopped lending or slowed down considerably, and the government had to rush in to prop things up. Presumably, that correlation will now resume. You can see the same thing for the UK, France, Germany, and China. GDP and private debt almost always grow in a very tight tandem. Japan, on the other hand, the relation got a little bit scrambled when private debt collapsed after their 1990s crisis, and they had to lean very heavily on government debt for rescue. But you can see that correlation has largely been restored and private debt growth has recovered. And if we adjust the starting point to 2010 or even 2020, you can see that the correlation between the two variables significantly increases as they slowly climb out of this so-called Japanification period. So if you want to know whether and how much economy is going to grow, you just need to get a sense, as the Federal Reserve in fact does in its U.S. lender survey, of how much private lending in a given country is going to increase. Now, this notion is, of course, very circular. Private lenders don't usually lend just for the heck of it. They tend not to lend unless the borrowing company is bringing some economic advantage or improvement that makes their prospects creditworthy. A lender presumably won't lend to a company that is making products that don't have an advantage relative to their competitors, but they will rush to lend to a company that is growing fast because it has innovated some way to build something either more inexpensively or in a way that has more functionality at the same cost, or something new that no competitor has yet introduced. It's a virtuous circle. Generally, private sector innovation and increased productivity is a magnet for lenders to increase their loans, and businesses innovate and increase productivity as a must in order to attract lender and investment interest. That's a long-winded way to say that in addition to high correlation between private debt and GDP growth, there is strong causality. It follows that in a country where private sector companies are innovating, loan growth will be faster. And in a country where innovation is moribund, they will not. As an important aside, the one place this virtuous circle paradigm does not work well is in real estate. Every so often, real estate lenders go a little nuts and start grossly overlending for real estate speculation, which of course brings a crisis such as in the U.S. in 1929, 1987, and 2008. We'll get into that at some point someday. It perhaps won't surprise you then, one of the happy consequences of this virtual lending circle is higher wages. So now let's look at the strong correlation between higher private debt and higher wages. The higher the private debt, the higher the wages. But importantly, it's not just private debt. Government spending to build or repair a highway or pay soldiers' salaries adds to GDP as well, not to mention crucial initiatives like the COVID rescue package. As we demonstrated in detail in our 2023 book, The Paradox of Debt, it is private sector and government sector debt for spending, which we call type 1 debt, that results in GDP growth. And I'd note that government debt growth alone is not nearly as tightly correlated to GDP growth as private debt is. So let's add private sector debt and government sector debt together and examine that correlation to GDP growth. It's generally even tighter than the already extraordinary correlation between private debt and GDP. For Japan in particular, as you might expect from our earlier comments, it largely restores the correlation between debt and GDP, lost somewhat when we looked at the early years for private sector debt only. As a result of all this, there almost isn't such a thing as a country with high GDP or high wages that doesn't also have high private debt, and to only a slightly lesser extent, high government debt. Private debt is the very thing most necessary to create growth. As mentioned, you need a loan for building a house or a factory, and it is the very thing that injects the money into the economy that results in higher wages. It's far from a perfect correlation, but this chart will give you the general idea. So that's our video for this week, and an important level set for those focused on private or government debt growth. But it begs the question, can the private debt to GDP ratio, much less the government debt to GDP ratio, continue to increase forever? Japan's government debt to GDP ratio, for example, is 221%, almost twice the level of the United States. Could, for example, private debt to GDP grow 200% or 300% of GDP without creating some sort of major adverse consequence? Presumably, there has to be a limit, and we have seen wealthy countries and poor countries get into trouble with a very high private debt ratio. But just how much is too much? That's another question for another day. That's it for this week. Thanks.